For an ordinary citizen who goes to the market one morning and sees that the same product is more expensive than last month, inflation is a simple word, a price hike. However, for large capital owners, the definition of inflation is not that simple. Rather than being explained merely as a price increase, it is understood as a transfer of assets. This transfer is quite silent. It does not make headlines, but its impact is just as profound. Inflation's basic definition is the decline in the purchasing power of money. In other words, while the amount of money in your pocket stays the same, what you can buy with that money decreases. But there is a critical distinction here: what you own. If you earn your income solely through a salary, inflation pulls you back. But if you own real estate, company shares, a factory that produces, or rent-generating assets, the situation in the picture will be a bit different. Because during inflationary periods, asset prices rise, house prices increase, lands gain value, stocks go up in nominal terms, companies reflect cost increases in their prices. That is, those who own the means of production can pass the rising prices on to the customer. The salaried employee, however, cannot do this. They are not the ones who determine the price. They are the ones who pay it. Consider a business person. As inflation rises, they take out a loan from the bank at a low interest rate. With that loan, they buy land or increase their production capacity. As inflation rises, the real value of their debt decreases. That is, the debt looks the same, but it actually becomes lighter. In contrast, the value of the asset they purchased rises. Here is the critical point. Inflation rewards the person who is in debt but invests in assets. Throughout history, a significant portion of great wealth increases has occurred during inflationary periods. This is because, during times when the monetary system expands and liquidity increases, those with the earliest access gain an advantage. The segment with access to banks, credit, and financial instruments catches this wave early. Those who are late are forced to buy into the price increases at their peak. Inflation does not actually affect everyone equally. While it is a threat to fixed income earners, it is a leverage for asset owners. The wealthy do not hold cash anyway. They quickly convert cash into assets. The middle class, more often than not, holds on to money and watches its loss of value. That is why inflation is not only an economic concept, but also a powerful mechanism that changes the distribution of wealth. The question that needs to be asked is this: is this mechanism maintained consciously, or is it a natural consequence of the modern capitalist system? Who benefits first when money is printed? An expansion of the money supply in an economy does not mean this money reaches everyone at the same time. In theory, the central bank prints the money, and this money spreads throughout the entire system. In practice, however, the process is much more layered than believed. Newly created money is generally put into circulation through the banking system. Liquidity is first provided to financial institutions. Credit channels are opened. Interest rates are lowered. At this point, the critical question is, who accesses this new money first? Usually it is large companies, financial institutions, and investors who can show strong collateral. Because these structures have direct connections to the system, their credit scores are high, and their risk perceptions are also low. This is where the basic mechanism of how inflation makes the rich richer begins. While the new money has not yet been fully reflected in general prices, the group with first access turns to asset purchases. They accumulate land, enter housing projects, expand their stock portfolio, purchase companies. Thus, until the money trickles down from the top, it passes through a sieve, and some of it turns into investment. The increase in demand pushes prices up over time. However, those who take a position before prices rise gain a significant advantage. In economics, this situation is sometimes defined as the first contact effect. When new money enters the system, Those who touch it first come out ahead, while those who reach it late encounter increased prices. Salaried employees generally feel inflation at the final stage because wage increases occur with a delay. While prices rise rapidly, the increase in income occurs more slowly. This time difference creates an unseen wealth transfer. Consider an investor. In a period when interest rates are lowered, they take a long-term loan from the bank and start a large housing project. Even if construction costs rise, they can constantly update sales prices. As inflation increases, housing prices grow nominally. However, the loan the investor took is fixed. While the burden of their debt lightens in real terms, the value of their asset increases. In the same period, a fixed-income employee expects a wage increase. They rejoice when they receive a 25% raise. But in the same period, basic expenses have risen by 40%. Even if their income has increased on paper, their purchasing power has regressed. This difference clearly shows why inflation does not affect everyone equally. When the money supply expands, the first movement is seen in the financial markets. Stock markets rise, real estate prices increase, commodities gain value. Asset owners see growth in their balance sheets. A significant part of this growth stems not from an increase in production, but from monetary expansion. The rich generally do not wait in cash. They quickly convert money into assets because they know that inflation erodes cash while it moves asset prices up. The middle class, more often than not, prefers to stay in cash they think is safe and realizes the loss of value over time. Thus, the segment with the advantage of early access to the monetary system expands its wealth, while the segment with late access carries the burden of increasing prices. In the next section, by examining the mathematical relationship between debt and inflation more deeply, we will handle why debtors are most often on the winning side with concrete examples. Why does debt become an advantage during inflation? One of the most misunderstood topics during inflationary periods is the nature of debt. For most people, borrowing means a risk. However, when used in a controlled and strategic way, debt becomes a powerful leverage in an inflationary environment. Because inflation does not only increase prices, it also erodes the real value of debt. Suppose an investor took out a fixed-rate loan with a 10-year maturity. On the first day, this debt looks heavy. However, as prices rise over the years and the purchasing power of money falls, the same nominal debt actually becomes lighter. If the investor has used the debt they took not for consumption but for an income-generating asset, the picture changes completely. For example, consider that they purchased a real estate property that generates rental income. As inflation increases, rents rise. The income obtained increases proportionately. However, the loan installments are fixed. Over time, the rental income covers the debt payment much more easily. While the burden of the debt decreases in real terms, the value of the asset increases. This is the mathematics that makes the rich richer. Because the asset owner benefits from the two-way effect of inflation, their debt erodes while their asset swells. For someone with a fixed income, the exact opposite picture emerges. If they keep their savings in cash, inflation invisibly erodes a portion of it every year. If they have debt but their income growth lags behind inflation, this time the burden increases. Therefore, the winners in an inflationary environment are generally the segment that has debt but produces assets. Throughout history, a significant portion of great wealth accumulations has occurred during high inflation periods, because these periods are times when asset prices go up rapidly and growth through credit is possible. Large companies invest in this environment, increase capacity, and buy out their competitors. Small players, while struggling with rising costs, may fall behind. The real power of inflation lies here. It widens the gap between those who have assets and those who do not. Debt, when used in the right hands, is a very strategic and important tool. In the wrong hands, it is a burden, The rich generally direct debt toward productive areas. The middle class more often than not goes into consumption debt. The difference between these two types of debt determines the distribution of wealth in the long run. In an inflationary environment, low interest, fixed cost debt turns into a chain that lightens over time. However, a non-productive debt is felt more heavily in the face of rising prices. Therefore, the issue is not just taking on debt. It is where the debt is directed. In the next section, we will examine how asset price bubbles and financial markets swell during inflationary periods and how this swelling causes wealth inequality to increase progressively. What is the reason behind the skyrocketing asset prices? During inflationary periods, people on the street feel price increases first on market shelves and in basic necessity expenditures. But large capital movements have started much earlier in financial markets. When the money supply expands and credit conditions loosen, the liquidity circulating in the system looks for safe and profitable areas. These areas are generally real estate, stocks, commodities, and value storage instruments. As demand increases, prices rise. As prices rise, the fear of missing out kicks in. Thus, the upward movement in prices gains momentum. What is critical at this point is this: asset prices often grow faster than the increase in real production. That is, while the real profitability of a company increases limitedly, its share value can swell faster due to the abundance of money. While the housing supply increases limitedly, its price can rise much more sharply. This situation creates a wealth effect. The asset owner feels wealthier because their balance sheet has grown. This psychology increases the investment appetite and continues the cycle. However, for the segment without assets, the same process turns into a barrier to access. A house that was affordable yesterday becomes unreachable today. An investment that seemed reasonable yesterday is expensive today. Inflation thus opens the window of opportunity for those who enter early and closes it for those who are late. Especially the segment with early access to financial markets sees this wave more clearly. Fund managers, large investors, and company owners evaluate price increases not as a threat, but as an area for growth. Because as the asset price rises, the collateral value increases, which creates more credit opportunities. In other words, the system produces a leverage within itself. Increasing asset value gives birth to new debt capacity, and new debt brings new investment. This chain accelerates the growth of the rich. The middle income segment, on the other hand, usually just watches the rising prices because their access to credit is more limited and their risk-taking capacity is lower. Thus, inflation pushes not only prices but also the distribution of wealth upward. Asset bubbles form exactly at this point. The abundance of money and increasing demand can carry prices beyond their real value. But during bubble periods, the greatest profit is usually obtained by the players who enter the earliest and exit at the right time. That is why inflation is not only an economic event, but also a game of timing. In the next section, we will discuss how psychology and expectations are decisive in this process and how people's behaviors accelerate the transfer of wealth. Psychology, expectation, and the invisible power of wealth transfer. Inflation is not only a mathematical process, it is also a powerful psychological effect. When people think prices will increase, their behavior changes. The consumer buys the things they want to consume today, with the concern that it will be more expensive tomorrow. The investor avoids staying in cash, with the thought that money is losing value. The company owner increases prices early, anticipating that costs will rise. Thus, the expectation of potential inflation accelerates the eventual reality. Inflation often grows not only through the money supply, but also through expectation management. In this environment, the segment with high financial literacy turns psychology in their favor. They accumulate assets during periods of panic, selling and act cautiously when excitement peaks, because they know that the market moves not just with economic data, but with human emotions, especially since uncertainty increases during inflationary periods. Herd mentality becomes even more effective during these times. The small investor gets on the train from the last carriage while prices are rising and is the first to panic when the decline starts. The big player, however, usually analyzes the direction of the wave much earlier. Expectations take shape before interest rate decisions. Pricing begins in the market weeks before the central bank's announcement. This early room for movement provides an advantage to the segment that accesses information and analysis faster. Thus, inflation supports the rich not only through monetary policy but also through information asymmetry. Another important element is the time horizon. The asset owner can wait for the long term. Even if the price fluctuates, they are patient because they have cash flow. The fixed income person feels the short-term pressure more intensely. Rising rent, increasing food prices, and the growing burden of bills push them to make quick decisions. This haste often leads to selling at low prices and buying at high prices. Thus, psychology becomes the accelerating power of wealth transfer. In an inflationary environment, fear and opportunity exist at the same time. While the fearful segment tries to protect what they have, the prepared segment focuses on expanding with what they have. This difference changes the distribution of wealth significantly over the years. This is one reason why inflation makes the rich richer: the capacity to remain cool-headed. In the next and final section, we will bring all these mechanisms together to see the big picture and clearly demonstrate why inflation systematically creates an upward flow of wealth. The big picture and the silent flow of wealth. For most people, the meaning of inflation is simply increasing prices. However, when looking behind the curtain, it is seen that this is much deeper and based on a system. The expansion of the money supply does not mean that new money will be distributed equally to everyone. Only a certain segment reaches this new money first, and these first-comers gain an advantage in the new order. When credit channels are opened, those with collateral strength move faster. The segment that takes out fixed rate debt and directs it toward income-generating assets expands its assets while eroding its debt in real terms over time. As asset prices rise, collateral values increase, which creates more investment and more growth capacity. Psychological waves accelerate the process. The one who panics loses, and the one who is prepared wins. When all these pieces come together, a silent wealth transfer emerges. Inflation does not directly appear to give money to the rich, but its mechanism protects and even strengthens asset owners. While the fixed income segment waits for price increases, the asset owner manages the price increase. This is the difference. During inflationary periods, the one who holds cash melts away, and the one who holds productive assets swells. The one who avoids debt may miss the opportunity, while the one who manages debt correctly creates a leverage effect. That is why throughout history, great economic leaps have generally occurred during periods of monetary expansion. But those same periods have also been times when income distribution deteriorated, because the system rewards early access. When we see the big picture, we understand this. Inflation is not only an economic problem, but also an economic power distribution mechanism. While it is a growth tool for the segment with access to information, credit, and assets, it is an element of pressure for the segment trying to get by only on a salary. Seeing this reality is not for creating pessimism, but for reading the system correctly, because those who can understand the mechanism can develop a defense against it or turn it in their favor. The reason inflation makes the rich richer is not a coincidence. It is the fact that money, debt, assets, and psychology work in the same direction. The important thing is to realize which side you are standing on. If this analysis has given you a different perspective, do not forget to subscribe to the channel and share your thoughts in the comments. In the next video, we will examine another mechanism behind the scenes of the financial world together.